and in depth, and I hope we get lots of questions and good discussion about them. The staff put together that estimator to sort of help frame everything. And so that's it. I don't know if people have any questions about the agenda, or I don't know if we've received any written stuff. If we haven't, we need to find it from public members.
Chuck, we did receive an interesting document from Charlie Swanson, who's on the call, describing various ways to estimate the costs of healthcare in Oregon and the different definitions. And that's available.
Yes, so, and it's posted on the website, on the OHA website.
On the OHA, okay. Okay.
And I know that he is additionally on the call. So when we break for public testimony, I know that he would like to speak.
Great. I didn't see it on the OHA website, so someone could tell me what folder it's in.
Yeah, so it's under today's meeting on the OHA website. And yeah, the title is, Margie, do you remember the title of the document? It's also in your inbox, Chuck.
Okay, there, I see it.
Great.
I see it now. Okay, great.
Great.
Okay, so I will look at that while staff starts going over the thing. Thanks for bringing that up, Sam.
Great. Well, thanks everyone. As you know, my name is Laurel Swerdlow. I'm with OHA, and I wanted to start today just by reminding everyone of the timeline that we're working under here. We are meeting today with a goal of being able to present some semblance of a proposal at the upcoming March 25th task force meeting. So we'll go through the estimator tool. We'll talk a lot about what we can and what we can't learn from that estimator tool. And then our goal is to start to hone in a little bit more on what you all would like to include in a proposal for the task force to consider and offer feedback on. The goal then would be, coming out of that March task force meeting, to incorporate their feedback and thoughts and refine that proposal for presentation at the April task force meeting.
Okay.
So as I said, we're gonna really try to be emphasizing what we can and cannot learn from the estimator tool. We wanted to start by reminding all of you what, or kind of making sure that we're all on the same page of the parameters that you all set coming out of our last TAG meeting. So coming out of the last TAG meeting, we really heard from you that you would like to see numbers, projections, estimates related to revenue that could be pulled together from a payroll tax, from an income tax, and from a sales tax. And that you wanted to kind of be able to use those building blocks to try to think through what types of packages you would be able to create to meet the revenue that you would need for this plan. And you didn't just highlight payroll, income, sales. You offered, excuse me, specific parameters to those three buckets. So we heard from you that you really are looking for a broad-based, low-rate payroll tax on employee wages above the FICA limit. We talked about, do you want that payroll tax on employers or employees? And we kind of, you all kind of landed on, let's kind of kick that can down the road a little bit, and just generally say it could apply to either. We wanted to highlight that we heard that you were looking for that broad-based, low-rate tax on all of employee wages. Due to data availability, the tool that you have in front of you, the estimator, is actually still specifically to employers with 20 or more employees. So estimates down the line that get at that kind of, we'll have to wait on estimates that get at that full scope of all employees. For the income tax, again, broad, progressive personal income tax. There was a real emphasis on it covering all income, not just wages. There was a desire to additionally apply that tax on non-wage income above the FICA limit. And then lastly, you talked about this sales tax. And the emphasis there in your conversation last time was really that you wanted to see this tax applied to all services with a very narrow definition of essential services. So again, this tax would cover, all services except essential services. And you wanted that narrow definition of essential services. One thing that this tool additionally does is it also offers estimates for a beer or wine tax. I know that we heard from you last time that you don't feel like sin taxes will really meet your needs. But when we met with Chuck in between, with Charlie Oshekatoff in between, we made sure that we talked about how it could be beneficial just to be able to have that in this tool so that you can play with this. There's a lot that we want to cover, so I really want to hand this over to Sarah. But we did want to kind of offer that these were the main takeaways that we got from last TAG meetings conversation.
Thanks, Laurel. So before we get started with the estimator, I do just want to acknowledge something that has come up over email a little bit over the last couple of days, which is the incredible work that Cheryl put into a document about reimbursement and revenue in the behavioral health system. Cheryl, that was just really informative, and I think is really valuable. I think a lot of the things that are raised in that document are actually really important for the larger task force to see, not just finance and revenue. It really touches on issues related to governance and provider reimbursement. And so we were going to just share that with the entire task force. I know there may be some questions and that sort of thing, but something that, it's not necessarily, we're not going to discuss it today on today's agenda, but just wanted to acknowledge that effort and make sure that it gets more eyes on it, because I think it really reveals it gives light to a lot of the things that you've been bringing up over the past several meetings.
Thanks. Sure, that's
Yep.
fine.
Yep.
Okay, great. So I want to just give an overview of this tool, and as Laurel said, this is really, we know that this task of trying to come up with a revenue package that would support the work of the task force and would be able to finance the plan is just a really Herculean task, and it feels really easy to get lost. And there's a lot of details and a lot of complexity. This Excel sheet that I sent out last week was really an attempt to just give a sense of scale and scope of what some of these different methods might look like if you were to move forward with really prioritizing them. These numbers are very, they are estimates. They are not in any way exact. They are not, official state of Oregon numbers. You can see hopefully in the Excel document, I kind of listed out where a lot of them came from. A number of them did come from the Legislative Revenue Office's basic facts. They publish these basic facts documents every year. Also, they came from the RAND report, Department of Revenue data, some IRS data. They have not been blessed by LRO, although late last night, Chris Olenek did respond and basically sort of acknowledged, a lot of the tricky elements that are at play here and trying to get better numbers on some of this. And I think we're all in agreement that this is really intended to be able to give folks an idea of where the big blocks could come from, and then where, there's other pieces that you might want to fill in the gaps. In addition, what I provided to you is just a couple of examples of what might fall within some of these, categories: income tax, payroll tax, etc. I know after we go through these, Chuck sent out something earlier today that he wants to talk through about what a more progressive version of a payroll tax might look like. So we're going to walk through some of the scenarios. I apologize because I know if you are running an earlier version of Excel, some of the functionality that I built into that document did not work for you, but we're going to go through some screenshots right now. Cheryl, did you have a question?
Yeah, just a really quick question. Could you remind me of the number that we're trying to get to with this revenue, with these revenue sources? I don't think I saw it in the charts, but maybe missed it.
No, you didn't miss it. I don't think that number has been set yet. We suggested that probably, 14 billion is like a minimum, and honestly, I would say probably not sufficient, especially as we're getting more details about, what the EBA tag has proposed. So in the tool that I put out, I allowed you to enter anywhere between 12 and 20 billion. But I don't think we have kind of this is the magic number that we're trying to get to quite yet.
Sarah, if I could also respond to Cheryl. Charlie Swanson's attachment is valuable. His document suggests that upper range 20 billion is probably appropriate for the scope of what we're attempting to do, especially things like behavioral health. So that's the number that I have been playing with, 20 billion, and I recommend that others use that as a placeholder until we determine another one.
Thanks, Dr. Metz. Okay. So I just wanted to highlight a couple of things that, as staff looked at this, that I thought were kind of these broad takeaways that I wanted to share with folks. So we discussed a lot of different options, a lot of different methods and different iterations within those. It really became clear to me, and hopefully to you all as well, that there are really, of the methods that we discussed, there's really only a few that are going to be able to generate substantial revenue. So I sort of arbitrarily picked, say, more than 5 billion. And, I kind of call these like the anchor methods. And so that, I think, indicates that likely one of these anchor methods would need to be included in a revenue package that moves forward. And so what those would be a sales tax of more than 5%, a substantial employer payroll tax, and or an individual tax that applies not just to income, but or excuse me, applies not just to wages, but to all income, which is something that we talked about at length at the last meeting. The other methods, sort of adjusting income tax rates a little bit up or down, adding a rate, another higher bracket on high earners or sin taxes can certainly be a part of a package that you all want to put forward, but their financial impact is much, much, much less. And so without one of these anchor methods, it's going to be really difficult to approach where you're going to want to get to. At the last tag meeting, we had this whole discussion and really at the end came to, okay, these are the different combinations that potentially you would want to see, what the impact would be of using these to base a revenue package on to fund the plan. And so that was kind of a combination of these three: payroll, income, and sales tax, a payroll and income tax, or an exclusive payroll tax. And some of this I think came out of what we saw in the RAND report, and then just also input from folks about, what they feel like would be important to try and dig into a little bit more and move forward with. So that's where we started. So Laurel, if you want to go down. So this is just a screenshot from the tool. And again, the numbers here are broad estimates. But this is just an example where if you were going to build something that included a payroll tax, an income tax, and a sales tax, here we have a sales tax of 8%. This is very similar to what RAND put in, which would generate an estimated $8 billion. We have an increase of 1 percentage point for all Oregon income tax brackets. So this would go, instead of the brackets going from, I think it's 7 to 10%, they would go from 8 to 11%. And so that would be about $1 billion. And that number comes straight from LRO, from their basic facts. You could, if we put in a payroll tax on the employer side, a 4% employer tax, and this again, similar to what, or not similar, but essentially exactly what RAND did, which would be, that would only be applied to employers who have at least 20 employees, which is about 10% of employers. That would be, another $3.5 billion. And then we have these employee payroll tax, which would eliminate that limit, that FICA limit, and tax all income, not just wages. This one's a little interesting because, in a sense, it's really just an income tax. We're sort of calling it a payroll tax, but any income that's coming through payroll is going to be wage related. But anyways, eliminating that FICA limit and essentially saying we're going to apply this 6.2% tax to all income, regardless of, if it's over the 137,000. And I know, Chuck, I'm just sort of recognizing that this one in particular really is where kind of your document would come in. And so, can definitely walk through that as a more progressive option to this. But this would, come in at about $3.5 billion. Another $750 million by eliminating that FICA limit on the employer side. So all told, one combination of these three kind of anchor methods of revenue would, generate somewhere in the neighborhood, a large neighborhood of 17 billion, give or take some. And you know, again, this would depend on what all these rates are, but this is kind of a more robust, I would say, approach to generating revenue to support the plan. I'm going to go through these and then we're going to have plenty of time for discussion and questions and all that stuff. But if you have specific questions as I'm going through, please feel free to raise them. The second one is just the payroll tax and the income tax. So this would mean no sales tax. We talked about, you know, what some of the potential limitations of a sales tax would be, which are that Oregonians have rejected it a number of times. But so this would just be looking at if we had a payroll tax and an income tax. And this is somewhat similar to the one you just saw, except that this also adds a new bracket to the Oregon income tax, so that folks making over, you know, 250,000 for a single earner, 500,000 for a joint earner would pay a 13% rate, and that would generate about 400 million. So you can see that taking out the sales tax has obviously a pretty big impact. Even in this example, we bumped up the employer-based payroll tax to 6.5%. The previous one was 4%. In our third model here, estimate, we have just a payroll tax. And as I mentioned before, that we have, well, so a 6.5% tax on employers with at least 20 employees. And again, this is a number taken from RAND, would be 5.6 billion. And then the next two, that first one, the eliminate the income limit for employees, but this would apply to all income, which we're calling a payroll tax, although, you know, this somewhat has income tax in there as well. So if this was the only method, I think potentially the rates on this would have to be much more substantial than what we're seeing here, because you can see that it's only, you know, would generate about 10 billion. So those were the three. I will, I guess, pause there before I go to the next two and see if there's any questions about these three.
Yeah, this is Glenn. I have a question. So again, how would this be? Okay, let me preface my question with this statement. The tax system is basically that we use is unethical, unequal, and inequitable. So how are we measuring for these models in order to be apply DEI principles so that we won't be leaving out particular populations?
And that's a great question, Glendora. And I think, you know, using an equity lens to these methods is really important. And I think when Chuck gets to his document that he's going to go over on the payroll tax, which is a much more progressive approach to a payroll tax, where the more money you make, your share of what you're paying increases pretty substantially. So that low and middle income folks, Chuck, please jump in if I'm saying something incorrect.
Yeah, I'll explain it when I get to, but I can talk. I'll try to answer your question, Glendora, when I get to mine.
That's okay, because I have follow-ups to that particular, you know, statement I made. So I can wait, Chuck.
Okay.
Thanks.
Yeah, and so let me know if I don't answer it. I'm sure you will.
Glendora, this is Laurel. You're reminding me that one thing that would have been helpful to include in this slide deck was the criteria that the TAG kind of brainstormed as helping guide to, as being principles or values to guide analysis of these. So Nipper, I might try to pull that up so that we have it, because I know the first one is related
Gotcha.
to looking at this through an equity lens.
Yep. Okay. Any other questions that folks want to bring up now? Okay. Or you want to go to the next one? All right. So we also just played around with a couple of other options that are combinations of things to get an idea. So in this one, we have a sales tax and a payroll tax. This would be a fairly high sales tax, 8%, and that 6.5% employer tax. And then a little bit of a employee payroll tax, which would just be eliminating the FICA limit on wages. So people would pay that 6.2% over and above $138,000, which is what it's limited to now. And so this comes in at about 15 billion. And then the last one we did was sales tax and income tax. So here we have a pretty substantial sales tax, 10%. And then again, it's a payroll tax, but really functions mostly like an income tax because it does apply to all income beyond wages. And so that, this particular combination would, get up to close to 14 billion. Which is probably not sufficient, but I think, again, a lot of these parameters can be changed. These are just examples, but just wanted to give folks a sense of what might happen with some of these different permutations and combinations. You'll notice that we did not include the beer and wine taxes in any of these examples. You certainly could, for sure. The examples that are given here, which is raising the beer tax by $1 a barrel and raising the wine tax by $1 a gallon. These numbers came, again, straight out of LRO's basic facts. They kind of model out these scenarios, what would happen if, and the amount of money that they would generate is pretty small. I want to say it's somewhere around 20 million. This is different than what is currently being considered in the legislature right now, which would generate more money than what's presented here. But that money already has some allocations attached to it that would be predominantly addictions, substance use related. So anyways, I just wanted to highlight the fact that these are here. Folks can, play with them, but we didn't include them in any of the screenshots or the packages that we presented here.
Sarah, I have a question,
Sure.
and I'm not an expert in this field, and I don't profess to be, but what are you basing the total revenues in sharing the total revenues that each of these methods will generate? What's being used to determine the estimated costs?
Yes, great question, Glendora. So broadly speaking, it sort of differs by which element we're talking about here. But for example, the sales tax, that is taken out of the RAND report. So when RAND did their modeling, which, could certainly be questioned, but was pretty complex and complete, they modeled the impact of an 8.4% sales tax in Oregon. And so I took that and said, well, what if we adjusted it downwards, or upwards? What kind of revenue would we get? Some of the other ones, like the income tax and the sin taxes, those came from estimates that the Legislative Revenue Office produced in their basic facts document. And the payroll tax, which is on the employee side, which is the most complicated to get to, came from a combination of IRS figures, Department of Revenue figures.
No.
And so it came from several different places. And that means that because I used what we had available to us, and none of us are actuaries or financial modelers, that's why I'm saying this is like, there are big parentheses around these numbers, but I tried to use the best that we had available to us.
Okay, thanks.
Sure.
And I'll add, all of those parameters are available in the tool itself, in the estimator tool on the second tab.
Yes, that's right. I did list out where all the numbers came from. Okay.
Should I talk about
Yeah, why don't you do that, Chuck?
can you put it up on the screen, or is that so everybody has it? I emailed it out. I'm sorry it was so late. And it's in that OHA site. So a little background. So when the way that spending and budget numbers happen in Oregon, when budget numbers, spending numbers, if a new program gets started or amended program, the agencies involved run, well, this is what it would cost us to implement it. They have to run it through the Department of Administrative Services budget office. And the budget office has sort of the final say from the administration side. And then at the legislature, they have their analysts and what's called the Legislative Fiscal Office. They meet with DAS and the agency, and they sort of have the final say on what a budget item is. If someone comes in and says, this isn't calculated right or whatever, Legislative Fiscal is the one who has the final say, because that's what's used for the state budget bills. On the revenue side, the Department of Revenue really isn't that involved. I think they may be if the governor is proposing a new tax in her budget, but at the legislative level, when bills are proposed for changes in the tax law, additions or changes, the Legislative Revenue Office has access to all the tax return data, not just summary data. And they have a model, they have a couple models, but they have a model that calculates out what the revenue would be in the implementation year. And it's based on all that data, on data from the most recent state economic and revenue forecast. It's based on knowing what changes have happened in federal law that sometimes has a direct impact on state law, absent any change by the state. They do it based on what laws the legislature's doing. So that's sort of the reason why these. Even if legislative revenue had put together this the little worksheet that they just went over, they would tell you it's very uncertain numbers at this stage, because they're still trying to figure out all the federal changes and its impact on Oregon, and then what Oregon's going to do in response to those federal changes, as well as the economic data from these last two unusual years, right? And so, that's why it's done that way. So the Institute on Taxation and Economic Policy is a nonprofit in Washington, D.C. It's the tax exempt group, tax deductible group associated with a group called Citizens for Tax Justice. And they, a number of years ago, created a model to look at, not only calculate how much does a tax change they raise, and they keep track of every detail in every state's tax system. When we change a deduction level or a rate or whatever, that gets into their system, and state economic data. And their model is able to spit out how much is raised, but most importantly, the model was created to look at who's paying it, right? And so, and they break it down by quintile or fifths. And we've gone over this a little bit before, but they look at the first 4 quintiles, the first 4 20%. And then that top group, they break down by the next 15, 4, and top 1. And that's because if you look at the income of the top 1% versus the top 99%, it's so much bigger. It would be wrong to sort of merge those into one category. And so they do a distribution analysis on proposals. And this is this is what they did for me. I said, well, I'd like to have a payroll tax modeled after the one that they tried to pass in Maine for, I think it was a home health care program. And they in that one, which is what's called the Maine style, is they say, well, you have a rate on the wages and then that are above the threshold limit. And these were done with 2019 numbers. So they used as the threshold 137,100. So an employee whose wages were below 137,100, there wouldn't be a payroll tax. And if it was $1 more, it would be a 1% on that $1 more, or whatever percent you choose. And then the main one also said, we're going to do it. I think they actually called an investment tax or something. But the payroll tax, or some people did, the payroll tax would also take for those people who have that high income from wages. It would look at their non-wage income and add in the tax on their non-wage income. I don't believe, and I'm still checking this, and this is sort of one of those sort of fine points that has to get worked out before you do a final calculation, that if you have let's say a retiree senior who doesn't have any wage income but has lots of investment income, it would not go to them. You only get taxed. The payroll tax only happens if you have wage income. So what kicks you into the non-wage income coming in. And so what this shows is it's you can see the income ranges for each of the quintiles, and then the top 15, 4, and 1% at that top bar. Then they said, well, if you just had a 1% payroll tax, it would raise, you'll see in the column over on the right, it would raise $1 billion, okay? Because this is in thousands, that's $1 billion. And it shows the average tax by income group. It shows the average tax by income group as a percent of their income. It shows the percent of income that gets the tax increase. Percent of that group with a tax increase. So the lowest 20% would only 2/3 of them would see a tax increase. Okay. The average tax increase for those with what the tax increase would be across the board. And then on the main policy, it cuts the revenue by about 1/3, by about 2/3, but it shows that you'd only be taxing people who are at the 80%, is at the the 60 to 80% category, the fourth quintile up, right? 80% and up, 60% up, and so the last 2 quintiles. So that's a way of making sure that the people who are paying it are only those at the top. You'll see it says in that middle line under the traditional 1% of employer-employee rate, they, like I think also the state, Chris Ellenack was going to check on their details of their model. Most economists agree that if there's a payroll tax, like our transit tax in the metro area or the unemployment insurance tax, even if the law says this is coming from the employer, it's not coming out of the gross pay of the employee, that for an impact, an incidence, it is really coming out of individuals. and when a business makes a decision of, do I add 10 people to the payroll, they're not just looking at what's the cost of their wages, they're looking at wages and how much they're going to have to pay in FICA and how much they're going to have to pay in any state tax by having that. So for distribution purposes, it doesn't matter whether we say it's a tax that the employer pays, or it's a tax that the employer just withdraws from the employee's paycheck, collects for the state. It's who ultimately gets hit. And so sort of this related to the workbook staff put together, you can just multiply any of the numbers on the right, the amount raised by, this is 1%. If we had a 5%, you would multiply 5 by all these numbers. And that would give you about what the breakdown is. The percent doesn't change. The percent doesn't change the distribution. It changes the dollar amounts. So in Maine, they were looking at a 3.8% tax that I guess was based on how much they thought they needed to raise. So happy to answer any questions about it.
Okay, can we put that back up there for a minute, please? Okay, so Chuck, would you say these estimations are more or less represents a means tested approach?
It is a means tested. The main one is means tested in that you're not taxed on your payroll, or the employer is not taxed on your payroll unless your payroll from that employer is above that threshold, that 130,000 or so threshold. So that makes it means tested, and so that's why in the bottom, that main style, when you see the percent of people with taxes, you see a lot of zeros and blanks. The first 3 quintiles don't get hit by it. It only hits people as you get up into the fourth quintile, and then the top 5th quintile. And you can see, because the top 1% earns so much more, they pay significantly more than the next 4% below that.
So do you know?
And I should also say that when it comes to actual when it comes to actual legislation, and we're sort of getting down to, this is the numbers that LRO says, this is a final number on how much we think this tax change will raise. What ITEP does is they look at their gross amount and make sure it's it's really close. And if it's not, they get together with LRO and figure out why are there differences. But their distribution doesn't really change. The little numbers will a little bit. The distribution doesn't. The state doesn't. The LRO typically doesn't do a distribution on all the tax stuff. So this number is also sort of still an estimate. I would never say to a legislator, this is what it's going to be. I would wait till we first saw the LRO number, and then had this adjusted to meet that.
Chuck,
what? Go ahead, Sam.
Thank you. Chuck, based on what you've presented here, what would be the 3, say, applications that our group should, 3 applications we should make based on this slide?
Well, I would say that because of payroll taxes, I think a payroll tax is going to get opposition from, regardless of who pays it, it's going to have opposition. If it's just the employers paying it, they're going to say, well, this is coming out of your wages, and so people will be pissed off about it, potentially. And if you just put it on people, they may say, well, making us mad. But I think what it clearly shows is if you believe that our added revenue should come from those with the greatest ability to pay, you do the main style. You know, in general, there might be some on the fringes modifications to do what happens when you have a married couple and one has income below 137, one has income above, and that non-wage income and all that. There's a bunch of little questions like that. But I would say try to raise, if you're going to have a payroll tax, I would want it to be only hitting the upper people so that 60% of workers will say it's not going to hit you. I mean, and Legislative Revenue Office would probably look at this and do their own calculation and say the same thing. That so you can sort of take away 60% of the opposition, in theory, by doing it this way.
Chuck, it appears that doing this main style on any given payroll tax, we lose 2/3 of the revenue, which means we need to either increase the sales tax or increase the income tax to compensate for it.
Or
And
increase the
maybe,
payroll tax.
we'd have to increase it 3 times if is that correct? I mean, I'm comparing.
No, you can't say increase it 3 times. It depends how much of the pie do you want to come from the payroll tax, right? And so if you want it to be the same amount as a flat payroll tax, yes, you'd have to increase it sort of 3 times about.
If I follow, Chuck, what you're proposing here is a progressive payroll tax, and what we're looking here in Maine is one example of a progressive payroll tax. Is that correct?
Yeah, it's right. I think you can call it progressive. Yes, it's a payroll tax on those with the greatest ability to pay, and that it's not, and it's saying, to the CEOs whose wages and earnings are much higher, you're going to pay a bigger share of what we're getting out of this type of tax than what would happen if it was flat.
I have a question, Chuck, if you're done.
Sure.
My concern is, given that employees do not have to pay taxes on fringe benefits, and the fact that the higher their tax bracket, they're paying less, and so what's the impact on the population in the lower tax bracket, that they will not have a choice of substituting employers' additional benefits because they don't earn as much as those in the top brackets. So how is that going to be equitable and equal, distributed to all populations, meaning the higher tax bracket wage earners versus the underemployed and the unemployed?
Okay,
That's
so
okay, go ahead.
So the way it works today is, let's say you have 2 employees, the lower paid person and the CEO. and they're both covered by health insurance that the company buys, okay? And the health insurance that the company buys, just for example's sakes, is $1,000, okay? So today, the employee doesn't really never sees that. It's not on your W-2, there's a box 12. And the box 12 is what gets filled in by the employer, that the employee really doesn't have to worry about it. It's filled in by the employer, and it includes a bunch of income that from the employer that's tax exempt, or comes through the employer that's tax exempt, things like pension stuff and whatnot, if you read the IRS instructions for Part 12. But it doesn't say if your only benefit is health insurance, you're not told, you know what, we gave you $1,000 of health insurance and you're not getting taxed on it. So employees don't know how much they're not getting taxed on. But the benefit to them isn't, both the employee and the CEO are still getting the same benefit, but it's worth more to the CEO. Because today that CEO's income tax rate, he or she is paying at the higher rate, right there at the top bracket. So it's that benefit has their income tax rate overall is higher than the lowest income person. And so the benefit of having that tax-free health insurance is much greater. And so the way this would work, the main style one would work, it would say, you lower income, the first 60% of employees, you're not getting taxed, so it's not having an impact on you. But you at the top 40%, you are going to have to pay, and your top 1% is going to pay a big chunk of it, of the tax. It's gonna have an impact. So that's how it deals with it, because the benefit today that you're getting is much more of a benefit to the wealthy person in sheer dollars, not as a percent of income, of course, but in sheer dollars, it's a bigger benefit. But it's a benefit, and that because it's a negative, right? You're not taxed on something that ought to be taxed under general rules of taxation, but you're not told how much that is. So you don't see, you can see on your W-2 how much was given to a 403B plan, right? Or something like that, tax free, but you can't see what's on your insurance. And so people don't realize the extent of the benefit. So even if you did just across the board tax, and so the average tax change was $79 for that lowest income person, as you can see in that left column there, the average tax change, people, I don't think know, well, what is my tax? How much is that different from what I'm getting my tax benefit of the insurance? They don't know, because it's not calculated. I mean, the benefit isn't there in the calculation of how much of a tax benefit is. So I think it deals with the equity issue. It gets rid of it gets, the current situation favors the higher income people on a sheer dollar basis. A deduction, when you have an exemption or a deduction, the upper income people get a bigger benefit.
And so when they go to the providers there, what is going to prevent the providers from picking from the top cream of the crop as far as reimbursement? Is going to be still a divide, whether we categorize it as classism or employment differences, income, wage difference there. So, I mean, when we think about the equity aspect, we have to consider, don't we, how it's going to impact the healthcare consumer at every level, because the higher the tax bracket, the more fringe benefits are, and the better if we keep this private employer-sponsored payroll coverage, we're still not getting rid of those, uh, uh, the equity problems that's going to come with it based on income and benefits and provider reimbursement preferences.
I'm not seeing it. I don't think it has. I might just not be understanding your question. I don't see how it affects a person's relationship with providers. This is, bring a way to bring money into the new universal program. So the provider is getting paid based on what we decide on payment rates and all that stuff. It has nothing to do with how much I paid in taxes. Just like, today, if the lowest worker and the CEO both have Aetna insurance and they have the same plan and they walk into a provider, the provider's going to get the same amount of money from that insurance plan, right? Regardless of the wealth of the insured. So this doesn't affect that. This only affects how much money we get into the system. It's more analogous to who's paying for insurance, right? And it's consistent with, the main one is consistent with our principle that we've talked about as a group, that the lowest income shouldn't have to pay more now.
Well, if the one earning top wages get better benefits, then he's going to be subjected to a high value quality care than the one who does not have the same coverage.
No.
John?
No, you can't say no because it's happening now. So I'm trying to get some clarification here, because you can't tell me no because I've experienced it. So now I'm trying to get some clarification. How do we prevent that going forward, Chuck? Okay.
Glendora, if I'm understanding this correctly, I mean, realize we're applying this to a plan where everybody is eligible. There's a resident and visitor status, but everybody's eligible, and everybody has the same benefit plan. The same benefit plan. For purposes of Oregon, Medicare, Medicaid, commercial distinctions disappear. Everybody has the same benefit plan. At least that's what I'm assuming.
Well, yeah, everybody should have the same benefit plan, but then that way that we will address the inequity and the inequality.
Yes. And providers, well, they do know who the really wealthy people are, but taking different care of them is not going to make any difference to them.
Right.
Chuck, let me ask a couple things just to clarify. Sure. So if I'm looking at this, 1% raises $352 million. 10% raises $3.5 billion. 20% raises $7 billion. 30% raises $10.5 billion. But who pays that stays the same.
Correct.
12% of taxpayers pay that.
Right.
So
right.
This is a very significant transfer of wealth.
Let me first, before you do your follow, let me just say that it's, and this goes to what Glendora was asking about. It's sort of like, I'm on a Medicare Advantage plan, and so is my neighbor. Let's say my neighbor's really wealthy. They're having to pay that extra IRMA, which I can't even remember what it stands for, fee,
right,
to Medicare. the provider that we go to, the same doc, doesn't know that my neighbor has investment income and is paying the IRMA fee, right? So you get the same care. It's just who's paying for it. More of it's being paid for by the person with the extra income.
Okay.
So now to your follow-up question.
Yeah. Then now you're calling this a main style payroll tax. That suggests to me that this is just for folks who are employed, though both
Yes.
their employed income and their other income is counted. It suggests to me that for the retired folks, this is not in play, even
Right.
though many of those retired folks may have very significant retained wealth and may have income to the same degree that this top 20% has. Are basically those folks who aren't working not considered in this calculation?
My understanding is they're not. I also think that someone who's working, but their income, the single person who's working, but their income's below the 130,000 threshold, but they also have investment income, they're not counted either, I'm pretty sure. That's sort of one of those detailed questions that came up when I went over this with the ITEP staffer that I'm trying to get certain on. And so it's not meant to, it's not meant to be the way to get income out of the wealthy. In general, it's a way to have a payroll tax that gets the wealthy workers, right?
Right.
And so right. So that's why you'll see, the payroll tax. Let me open that. It's my bigger copy of the screen. That's why under the main one, the first three columns, the first three quintiles are zero.
Right.
Because there's people earning, in those quintile levels, earning maybe $71,000, $70,000 who might have investment income, right? It could be even a lot of investment income, but they wouldn't be taxed. So it doesn't, it's not a way to get at all investment income. There's other ways to get at people with investment income, but this is to have a payroll one. It's sort of like payroll plus. I guess I would say upper payroll plus is what I would call it. It's the upper payroll people plus their other income, which they typically have. Right.
So you still, I bring this up because at yesterday's or Monday's CAC, a member urged that we look at tax strategies related to retained wealth. That was the term he used, which I agree with. So that might be a source in addition to this.
Yeah, we're as I think Chris addressed it a little bit in one of his two presentations. It's very hard to design a wealth tax. As far as, the tax system we have today generally is voluntary. There's a little bit of paper that follows you that's supposed to raise red flags if you don't pay or you pay too little. But so it's really hard to have a wealth tax
right.
on stuff. I mean, it's sort of, I'll just leave it at that. So there's been proposals for that. The person who has very little income, they're living on Social Security, but they're in the massive house that they bought when they were very wealthy. And so they have, high payroll. They might have high property taxes because of that. But that house may be worth $5 million today. And they're, you can't make them sell it. And you can't, it's hard to figure out a tax on that.
Right. Well, I think this is very interesting.
Yeah. So there are some, I should say, there are those little things like, well, what happens when my income is below the threshold, my spouse is above the threshold, and our investments are held jointly, right? Does that mean the investment income gets taxed or only half of it gets taxed? I don't know. how that would work has to get worked out.
Right.
You know,
Right.
details like that, which would be, you know, numbers on the fringe, not the most numbers, right?
Right. And, you know, it would certainly incent dysfunctional behavior by the very wealthy to shelter their taxes or shelter their income in a variety of creative ways.
Right. Right. I mean, a lot of tax, you know, what accountants and lawyers do is to figure ways around the system, you know,
Yeah.
and
Yeah.
that's why the tax code's so complicated, is to try to close some of those or create them.
Yeah.
I know that Dr. Chadwick has a question. Can I pause and just do a
Yes,
scan
definitely.
and see who else is in the queue here? Is there anyone else who'd like to ask a question at this time? Okay.
Well, you know, I actually wanted, I think Chuck's work is very impressive, and I think that it adds to the array of options. My question is really a little more overarching. What I heard is that the requirement was in the nature of $20 billion. And I have yet to see a model which raises $20 billion. And so here is my question. I presume, but maybe I shouldn't presume, that this, because this is dependent upon the benefits group coming forward as well, but I presume that this is predicated on no cost sharing at any income level, or any cost sharing at all. That is in the form of co-insurance or co-pays or anything. Furthermore, I assume that things like long-term care are included in this. And then the last thing is, I'm curious about what has been assumed as it relates to reimbursement, and the notion that I think Rand put forward regarding a 10% haircut for reimbursement. And I presume it doesn't include that haircut. Here's my overarching sort of thought about this, which is that though it's meritorious to try to figure out how to raise $20 billion, I think we should, as a group, at least have some models that show some other scenarios on the cost side, or on the co-insurance side, or on what if we don't have long-term care, or whatever. Because you know, at the end of the day, we could feel that when we really face this, the $20 billion is somewhat untenable. And then I just feel like at some point we need to have some fallbacks. I mean, I understand the philosophy of, you know, of equity and so forth, and I appreciate that. But, you know, it seems to me that maybe we ought to know what it's going to be if we don't have long-term care, or what it's going to be if we had some form of cost sharing for high earners. So I just raised that because I think we're kind of tied into this $20 billion, and I'm worried that it's a big hill to climb.
I think if I could respond first, I'd like to hear other people's rules. So that's sort of what, you know, our $20 billion problem that you described is sort of the problem that Vermont ran into. The number to raise was too much for anyone to stomach. You know, I can get close to it in the calculator from staff by putting in a 10% sales tax, the highest rate on the two income tax things, add those in, put a payroll tax at 6.5%, eliminate the FICA limit. You can get up to like 18 million, right? 18 billion. But, you know, is it politically possible? Probably not. So I think we need to come up with a plan for overall true universal care. But I also think our plan has to be, what can we implement that doesn't require the federal changes, some of the federal law changes, right? Some federal approvals and law changes but can grow. So I would want the plan to, as if we're going to do something that, for instance, we can't outlaw without ERISA law change, we can't outlaw employer provided coverage, but we can do things to encourage they drop it and discourage that they keep it without running afoul of ERISA. And as that happens, as more employers drop it, we want to have a tax system that can cover those new those people who are now getting picked up by the state. And so we need to have the taxes need to be able to adjust accordingly to the change in who's now covered. So it may mean that, you know, it may mean that a payroll tax goes up over time, or adjusts based on one of our other taxes adjusts based on the health of the fund that we're going to create to pay for healthcare, which is what happens with unemployment insurance. You know, companies pay taxes into it, and then every year the employment department calculates, do we have enough money for a big recession? And if not, we're going to move to a different tax table. And so we may want to have that for those changes over time. But you're right. I think getting to the universal is very hard to stomach. Sam's email he sent to us a week or two ago, you know, said, well, you know, let's double the income we get from the income tax. You could do that just on the highest income people, but who pay most of our income taxes. But it would be a big lift politically.
If I could, I'd like to share in response to Chuck, Chad, and Glenn, some of the points that actually Nipper brought up in the first slide. Here are my take-home messages, and I want to make sure that everybody's taking home some of these same messages. One is we need a sales tax, we need a payroll tax, we need an income tax, because to leave one of those out would devastate the other two. For a sales tax, let me back up just one more step. I'm working on a $20 billion budget. I think we're in much better shape if we say, whoops, we're collecting too much money and cutting back than we are going the opposite direction. How do we get $20 billion? I say we should get about $6 billion from a sales tax. That's sort of equivalent to, you know, each 1% of sales tax, if it's as broad as possible with that narrow essential benefit that Chuck suggested, each 1% sales tax generates about $1 billion. I'm going to suggest we start at 6%, mostly because that's what our neighbors are doing. Idaho is 6%, Washington is 6.5%, California is 7.5%. If the first sales tax that Oregon comes up with is more than any of our neighbors, we'll draw a lot of lightning. Second, a payroll tax. Now, based on the figures we've seen and some of what Chuck has been sharing, each 1% of sales tax generates another $1 billion. Now, that presumes a flat across the board sales tax. Payroll tax. Thank you for correcting that, Chuck. And I think we should make that payroll tax somehow progressive. I think the main model is extreme, but the concept of coming up with ways to soak the working rich based on their salaries is equitable and reasonable. I don't know how to do that. The main example is one model. That leaves us with $8 billion to come up with in income taxes. I do not have a good handle on how to essentially double what Oregon pays in income taxes, but I think each one of those is equally bad politically, broad-based enough that we can raise the money without getting too dramatic. I'd also like to suggest, as Nipper did, we drop the concept of sin taxes. Sin taxes are too small, there's too much competition for them, and by the time we get to alcohol taxes 5 years from now, we're going to discover that someone else has already put in a tax. So To repeat,
Dr. Metz, oh, go ahead.
$6 billion from sales, $6 billion from payroll, $8 billion from income.
Can I ask, so we've clearly moved into the portion where we're starting to discuss the options. Les, I see you in the queue. I did want to follow up though with you, Dr. Metz, to make sure that I'm capturing this accurately on this slide that I'm taking notes on. Am I essentially hearing you kind of reframe this option here of the payroll income sales, in which you're setting the sales tax at 6% and then making that payroll tax more progressive and then increasing the income tax in order to meet the rest of the revenue needed? Is that an accurate regurgitation back to you?
Yes.
Okay, thank you. Les, I see your hand. Go for it.
Okay, so the thing I'm trying to wrap my head around is where the employer contributions are at in this. I mean, I know it's right now, like I'll just use my employer as an example. They're contributing like $1,400 a month for Moda OEB for my work at the college. And I mean, for a lot of workers at the college, as Chuck's already mentioned, that, I mean, that's a huge chunk of, you know, if you took that amount of money and you multiply it out monthly, that's a huge chunk of their salary if you're earning, you know, 30 to 40,000. So I'm just trying to figure out, you know, my understanding is the payroll tax is going to try to recapture that employer contribution. Or are we saying that employer contribution stays constant and we're going to add this payroll tax? Chuck, I'm just trying to figure out that employer.
So you're was it $1,400 a month? Is that what you said?
Yep.
Yeah. So that's what they're paying for your insurance.
Right.
Right.
That's their portion.
So right. That's their portion. And so the rub is we don't know, we can't sort of find a dollar amount written down somewhere. How much would they be paying you if we had universal care today, right? If there was Medicare for all had gone in when Bernie Sanders first asked for it, how much would they be paying you that $1,400 more? Who knows? Probably they'd be paying some of it, because and the economists will say yes, for the purposes of if we could devise a tax system that said for you having employer provided coverage, we're going to tax you exactly what you were paying in health insurance, right? We're going to look at your bills over the last 12 months for less, and we're going to tax you that much on his wages. It would be a wash, right? You would think, but the fact is you are getting paid less because of them paying that.
I've been in many union negotiations where that was the reality.
Right. And that's one of the reasons that how much you're actually getting paid, that people on their and you can sort of figure out, and you could probably do the math on, okay, I do pay some of my income at the top bracket of 8.75%. So 8.75% of that 1,400 is what I'm saving in taxes each month. And you could do that and then calculate, oh, this new payroll tax is less than that for me, so it's a good deal. But people aren't going to do that. So
so we don't have a way to recapture that contribution currently. And are we concerned that there's a federal reason we can't just employers you have?
I mean, I think it's the reason when you say recapture it, that's why Sam in his example said, let's have a 6% payroll tax, because that's about on average percent of payroll that goes to health insurance from employers based on the estimate of what health insurance is. No one has a hard figure on what the health insurance cost is for employers. Okay. It's not reported on tax returns that way. So that's an estimate. Now, of course, the health insurance as a percentage of your wage is different than the percentage of the college president, right? So that's one of the problems of doing it at something on average. But
An average, less to talk about how do we try to replicate what's going on now, a principle that Glenn suggested earlier, is about 3/4 of the payment that employers making now for healthcare comes from the employer, and 1/4 comes out of salary. Of course, that's going to make a bigger difference if you're a landscaper and you've got 1/4 of that coming out of your salary. And if you are an architect, I don't know how to describe making that progressive. So higher paid employees pay a greater proportion of this payroll tax. But I would be comfortable saying we start at a 75% employer, 75% employee concept and work from that to make it more progressive.
and so the main one tries to make it so a higher percentage, because it's saying if your income is below that FICA threshold, you're not going to pay it at all. You could, another way of doing it is say, we're not going to start charging you till your income is at the FICA level. And then when it's like 3 times the FICA level or twice the FICA level, the rate changes. You can have a progressive rate up the income scale as well. This is, a flat tax. That's why I sort of cringed a little bit at calling it progressive. It's a flat tax, but it doesn't start but it exempts the lower income people, 60% of the people.
Dr. Metz, can I just ask a clarifying question? When you said you want to shoot for 75% on the payroll tax, what did you mean by that?
I don't know what I meant, honestly.
Okay.
I think you were talking, Sam, about the 25% employee, 75% employer split was sort of your ideal, I think.
No, yes, that is true, Les. It's not, I don't think that's ideal. I think that's the current reality. And if we're going to start with the current reality and move progressively from there, I suggest that be our starting point.
And, and I would just say, I think it's a 60-40 split on the new paid family leave thing. I can't remember the actual split, but I think in some ways it's sort of, it sounds nice, but I do think that all of it ultimately does come out of people's wages. And so it's just a matter of whether you want to make it seem like it's coming out of the employers. So the employers, the way it works today is you get $1,400 of benefit that the government doesn't tax, state and federal government. That's the $1.6 billion tax expenditure for employer provided healthcare. Your employer, let's say you were working for a tax-paying employer, not a public entity, your employer gets to, in calculating their profits that are taxable to the federal government and the state, that's a legitimate expense, right? So it comes out on their side as part of their business expenses. If we do a payroll tax, it'll come out on their side as part of their business. That's a legitimate business expense that they'll have. And that wouldn't affect you other than that it's sort of hidden, you're not getting it in wages.
So I've seen Dr. Sana's hand. Is
Okay.
there anyone else in the queue? Go for it, Dr. Sana.
Yeah, I just want to support where Stan is headed and, recognize Chad's concerns. I mean, it's just time, I think, to put a stake in the ground. That's what we've done with eligibility. That's what we've done with benefits. Put a stake in the ground so that, you can start to get on to what happens then when other wheels turn. For example, I'm still wondering what's the net effect on state taxes when the state no longer needs to pay for healthcare, when counties don't, when cities don't, when no public enterprise has to raise taxes to pay for healthcare. It's the single payers covering all of those folks. I would assume somewhere along the way, Oregon would say, you know, there's no deduction for healthcare any longer, because all your healthcare is with the single payer. You know, what will the federal government do vis-a-vis with the federal employees that are in the state? So there's a lot of other wheels that are going to turn here. I mean, Chad, I would assume negotiating those global budgets with hospitals are going to start with, you know, we're no longer going to include healthcare for your employees. You know, your costs are going to drop by 20% because we're going to be covering your employees, not you. So there's a lot of wheels that turn here, and you know, I think to move along, we should put a stake in the ground for the sake of a discussion on the 25th, and you know, keep moving on.
I have one recommendation. And during my
I do know that Les was in the queue. Was there anyone else in the queue?
No, add me.
Okay, great.
Thank
Les,
you.
go for it.
Yeah, I was just gonna comment. It's gonna be short. I was just gonna say that, you know, for I'm just like doing the math in my head, thinking about what people make, and 6% seems a little low, you know, in terms of the percentage of our income, you know, in the public sector, that is the healthcare benefit. So, you know, I'm fine with starting at 6%, but I feel like that's a little low. The one thing that makes me a little nervous is I don't know about small businesses that may not be contributing to healthcare currently. I don't know enough about them to know, you know, is this, you know, are they going to be jumping on a treadmill going pretty fast all of a sudden to try to get to 6%. So, you know, I'd like to know a little bit more about what is it going to look like for small businesses, and what do they currently have to do under you know, ACA or those requirements, in terms of basically what percentage of their budget is going to be and payroll is healthcare, because I just don't know enough about them to know how it's going to affect them. Okay, that's my 2
So
cents.
then, Les, did I capture this concept here accurately? Your concerns are with respect to the payroll tax, correct?
Right, the payroll tax, and
Yeah.
I see that being, you know, a big boon, like John was saying, you know, that that 6%. I could see a lot of public sector organizations being all for that, but I just don't know if it's high enough. And I worry, and then on the opposite end of the spectrum, you know, for small businesses that may not be you know, paying in at this level or doing a high deductible plan or something, what percentage are they paying, right? And how does that look for them? And I
Thank
guess
you.
that may be something to ask of the Community Advisory Council, if there are some small businesses in there, so we could maybe get a picture into what they're dealing with. And that's my 2 cents.
So I see Dr. Metz's hand. We'll go Glendora and then Dr. Metz.
Yeah, I would like to task force to consider the employer mandate bill that was worked on back in 1989. It was it required a waiver request from ERISA, but because they didn't meet the deadline, the bill was repealed. So I'd like for us to examine that bill to see what it can offer with reference to generating revenue.
Thank you. Dr. Metz.
Thank you. Les, I can give you some crude numbers about how much businesses are paying for insurance. There are no good numbers because it's all private numbers and nobody will tell you this. The average business in Oregon that purchases insurance for its employees pays approximately 12% of payroll for those premiums. That's both the employer and the employee contribution. However, small businesses like local and county governments pay much more, probably closer to 18 to 20% of payroll for those premiums. On the other hand, large businesses, hundreds of employees, can get great group rates from insurance companies, and their costs are probably 8 to 10% of payroll. Humongous companies that self-insure are even more efficient, and they pay somewhere around 6 to 8% of payroll for healthcare. Small businesses of under 50 people don't buy health insurance and they pay nothing. Of course, all of the employers and the employees have to go out and buy individual policies, which in turn might be 20% of their income. The long way of saying 6% is the minimum we should consider in a payroll tax. The only reason to consider 6% is we can be sure that every large business and small business in Oregon that's currently paying for healthcare will think it's a great deal.
This is Chad.
Yeah, just for a point of clarification, just to get my question resolved, is long-term care coverage included in this $20 billion estimate?
So may I just to interject here? So it's a great question, Dr. Chadwick. As I have understood the task force's current decision on long-term care, it is that long-term care would consider at current levels and would consider and would continue to receive the current federal funds and Medicare match, excuse me, and Medicare dollars from the feds. And so this 20 billion would not need, the state would not need to raise additional revenue in order to cover long-term care as the current task force recommendation stands.
So long-term care is under the umbrella of this plan?
Current long-term care that's paid for with Medicare and Medicaid dollars. So the wealthy elderly person who has doesn't qualify for Medicaid or in-home care that's not paid for with Medicaid, like Oregon Project Independence,
would have a spend down.
Doesn't have the coverage.
They would have a spend down, right?
Right, but if they don't, if their assets are too great and all that, they don't have the coverage. If they don't have health.
So I'm just trying to be clear. So the long-term care is really outside of the plan. It's as is.
Right.
Yeah. If I could though, Chad, I mean, I think you're appropriate to be raising concerns that substantial exposures are out there. I mean, I think there's some very substantial exposures out there that we haven't discussed yet. For example, will the single payer pay the Part B premiums for Medicare folks?
Right.
Will the single payer pay all of the cost sharing that Medicare folks pay now? Will the single payer
all the supplemental insurance?
Absolutely. I think we have a huge exposure on Medicare that no one has taken up. So, you know, that's what I say, put a stake in the ground. There's much more to come.
I'm just trying to understand the stakes, John, that's all.
Yeah, yeah.
Yeah.
I think the point, John's point's a good one, that we're putting a stake in the ground on what the goal is, just so we have a number, and we're putting a stake in the ground, and maybe most importantly, we're not putting a stake in the ground for things that are so small, like sin taxes, that we'll be happy if they get raised and they'll go into the pot of money if they get raised, but that's not where we should be focusing any attention. So other comments or questions that?
I see Dwight's hand.
Yeah, one thing that we had talked about at one point, and it's not figured in any of this, and maybe it's a figure that's too small, or we don't know how to compute what the amount would be, but we had talked at one point a luxury tax on things like large luxury boats, yachts, private jets, luxury vehicles, those kinds of things. I don't know how much that would generate. I don't know if there's a way to figure how that would generate, and is that worth consideration in all of this?
Yeah, Dwight, I'll just give a real brief answer to that, which is it wasn't one of the things that the tag prioritized last time, but for my own curiosity, I really did try to dig into that. And there's two issues. One is it is almost impossible to get any real reliable estimates of things like, furs, jewelry, boats, that are publicly available that could be used to kind of look at this. But the bigger issue is when we look back to what the impact was when the US did it for the whole nation, I don't remember the numbers, but they were pretty low. And so I think that a luxury tax is really going to fall into that broader sin tax category of it's not really going to move the needle very far on getting to that, 20 billion.
And I suspect it's somewhat covered in the sales tax, because if you're buying something new, you're going to pay that tax.
That's right. That's right.
That's right.
I'm just looking at the time. Oh, go ahead.
I just want to say some of the Oregon, to its credit, continues to have an estate tax that picks up some of the income from wealthy, and we do tax capital gains income as if similarly to wage income. Some states don't, and the federal government doesn't. Another area that could raise some money, but it's not of the magnitude that we're looking at, is changing the corporate taxes some more. So I think, at this juncture, we're sort of keeping away from the smaller ones. Some of the luxury things like have to do with property taxes, and they get tax breaks there. And we could certainly recommend that those things get trimmed, but I don't see that adding up to a lot of money.
So I know that Cheryl and Les both have their hands raised. I want to just make sure that we are leaving our conversation today with some semblance of a proposal to be bringing to the task force at our March meeting. At this point, the proposal on the table, the proposal to beat is 6% sales, 6% progressive, payroll tax, and an income tax to get to 20 billion. So Cheryl, I definitely want to create space for you, but for the rest of you, if you can be thinking about, is there another proposal that you want to be putting forward here? That would be really helpful.
Laurel, I just want to correct your revisit 89, ERISA. It is revisit Senate Bill 935 that was considered in 89.
Thank you. Okay, Cheryl, go for it.
I was just curious when Sam was talking about percentage of health benefits to the gross pay of your employees as a small business person. So I did a back of the napkin check, and for my group, I have a very small not-for-profit. It has 8 employees. I pay 16% of their gross salaries in benefits right now. I'm just talking about health benefits, not retirement or anything, just health benefits. And I pay 9% in payroll tax on that, the gross pay. So just as an example, I thought I'd throw it out there.
Thanks, Cheryl.
Mhm.
So I'd like to ask, are folks interested? I feel like one big component when you look at these, I did put in these values here so that we have them in this slide deck. But when we look at these options here, you know, just going back to those anchor methods that Sarah was talking about, you know, it's really clear that you really are going to need either a sales tax or a payroll tax in these options. Chuck, did I see you shake your head no? Does that?
Well, yeah, I just, my problem with Sam's proposal is saying that, you know,
Yeah.
how much money to raise off a progressive payroll tax. And I don't know of another way other than some version of the main one. So I would have it say an 18% progressive one, and progressive being another word for main style, right? That would raise the 6 billion from that, and it would only hit the top 40% of taxpayers, mostly the top.
And you would include sales as well?
And I have no problem, because I do think we'd have to increase the payroll a lot more or do more to the income tax. And so, I don't really trust the sales tax numbers, I should tell you, because, but I think to get to the big number, we have to sort of do what doomed the program in Vermont, come up with a big tax increase.
So how would I capture kind of your vision?
Well, mine
here
would
on
be
this slide?
Sam's is fine, but instead of saying a 6% progressive payroll tax, I would say an 18% progressive payroll tax, with progressive payroll tax being a synonym for main style until we hear some other way of doing it. That I don't want the payroll tax to hit the lowest income people.
And then additionally, the income tax to get to 20 billion.
Yeah. Because his was 6, he had if I'm correct, didn't he have 6% payroll tax to bring in $6 billion, right?
Yes, that was the
Yeah.
presumption.
Yes, so I just think we make it 18% to bring in 6 billion by making it progressive. Making things progressive costs money. Sometimes, you know, how progressive you're doing it affects how much money. So, you know, a sales tax will bring in less money if we work into which I would assume we would, like all other sales tax proposals that have been considered by the legislature, we would work in credits for low income people that would offset their sales tax that they pay and whatnot. But it wouldn't reduce it by 2/3.
So then can I ask, is there anyone here that is interested in either striking the income tax and increasing either sales and payroll, or striking the sales tax and increasing income or payroll? Or is everyone here kind of leaning towards having some breakdown of all three methods?
I cast my vote for all three.
I would agree with that. I think we include all three. We don't know, for example, 75% of Oregonians are at this point opposed to a sales tax. Whether we can change that attitude because it's going for healthcare, would that change that resistance? But I think if we start with this, then if we have to wipe out the sales tax, or the legislature has to wipe out a sales tax, then they know what they need to backfill it with, at least.
Others?
I would say I would like to make it more income tax heavy, but I don't think it's feasible. Like, I don't think we could sell it.
But you are in favor of including some breakdown of all three methods?
Yes, I'm in favor of this. I would love to lean more on the income tax, but you know, so I guess getting at, you know, could we leverage less sales tax and increase the income tax and get to the same spot with a stomachable amount of an
Yeah.
income increase is what I would like to do, just because of how regressive sales taxes are.
And we can have a more, you know, we could have the income tax be even, the extra money from the income tax be more targeted to the upper income than what the options were in the worksheet we were given, right?
Chuck, are you saying in a
You could have a 13% rate, and you could have, you know, a 15% rate for those earning $1 million and more,
right,
right?
and get rid
And-
of the sales tax in so doing?
or reduce it or whatever. You could, right. So you could, there's ways to get more money out of the income tax that are progressive, by keeping it up
Because
on
the progressive payroll tax, the main style one, right? It does not include tax. It does not tax non-wage income, right?
the main style one does tax non-wage income of those people whose wage income
Gotcha.
exceeds the FICA limit.
I see Dr. Metz's hand. I'd like to pause and ask, I have Charlie Swanson as wanting to offer oral testimony. Is there anyone else on the call that was hoping to offer oral testimony? Member from the public? Alex, okay. So we'll go ahead. Go ahead, Chuck.
No, you go ahead.
I was gonna say, Dr. Metz, I'd love to hear from you. I think we can go ahead and continue this conversation for a few more minutes and have time at the end for both Alex and Charlie.
I defer to our two guests. Thank you.
Okay, well then, go ahead.
Yeah, this is John. I would just favor the 6% sales tax, 8% progressive, and the income, all three on the table for now. I think we're going to find some other sources of significant income down the road, but put those three on the table to get into the mix with the task force, can start getting them thinking.
Glenn, I agree.
This is Chad. I agree.
Cheryl? Les, or we heard from Les, I think.
Yeah, this is less. I'm in agreement that we need all three. Just the ratios is what I'm interested to hear what the rest of the task force has something to say about.
I'm fine with that too.
Great. Thanks, everyone.
So on to the public testimony.
Great. Let's go ahead and start. I know that Charlie reached out, so let's start with Charlie, and then we'll turn to Alex.
Hello, thanks for having me today. So I want to attempt a beginning of an answer to Chad's question. So the $20 billion number, I would say there's no clue as to whether or not that is right. That's essentially what my paper that I turned in to the task force was an attempt to begin the conversation that I think is absolutely critical to this task force. And to begin the conversation about how much revenue is necessary, I think you should start with what are current expenditures. And since 2020 was a bizarre year, I think you should look at, and I tried to look at 2019 expenditures. And you would think it wouldn't be that hard to make good estimates of that, but I think it is hard. And I would say that the RAND report's number for healthcare expenditures, which they said they projected at 2020, are not credible. At least, it depends what you mean by them. So one of the things that matters is what kind of healthcare expenditure are you talking about? Are you talking about personal healthcare expenditures, health consumption expenditures, or total healthcare expenditures? These are all terms that I defined in my paper. They're terms that are used all the time by CMS and other people who look at expenditures. And so you need to know which one you're talking about. And so if you look at the RAND report, it's pretty clear that to some extent they were talking about health consumption expenditures, but they left out a bunch of categories that are really important. And so I tried to detail what categories it seems like they were left out. And so that's the beginning. Once you get an estimate of expenditures in Oregon, then you can say, well, what kind of administrative savings might you get in a single payer system? What sort of monopsony purchasing savings would you get? What kind of utilization increases do you get? And I think to Chad's other question, does this include long-term care? Well, right now we have no clue because we don't even have a decent estimate of what the expenditures are in Oregon. And certainly the ones that are there, the ones that have been given to the task force are not credible, at least, or they're not explained enough. What do you mean by that? So my paper is an attempt to do that. I think it's critical that the task force try to do that. And I would say that among the places to get the best information is going to be the Oregon Health Authority, the Department of Consumer and Business Services, and Oregon counties. And they're all ex officio members of the task force. They are, well, the county isn't, but the DCBS and OHA are, they're directed to help in any way they can on this. And of course, OHA has been helping, but the more help is needed. So the Oregon Association of Oregon Counties needs to kind of chime in on, well, what expenditures are made at the county level? So some of them are public health, but my paper talks about this to some extent, but some of them are not. Some of them are for individual healthcare, and it's, they would know better than probably anybody else what they're spending on that, and you should make use of them to try to find that out. And how much public health you include as part of the expenditures depends upon, well, how do you define the difference between public health and individual health, and what do you want the single payer system to do? So I think these are all questions that need to be talked about. Another category that is important, based upon what the task force has been talking about, is expenditures on structures and equipment. So if the task force is going to help pay for those, or maybe pay for a lot of it, I don't know how much people are thinking about, you need to know what the current expenditures are and what you can expect in the future. And you got to start with somewhere, and the start would be current expenditures. So I'm really, really trying to encourage the task force to seriously think about this issue and try to get an estimate. And so that the question Chad asked can be sort of answered, at least modestly so, rather than having like is it 12 billion or 20 billion? Or just guess. I mean, I think 20 billion is about right, in fact, but for reasons that need to be explained and talked out. So anyway, I really encourage you to think about this much more seriously than you have so far. Thank you.
Thanks. I noticed that Warren, George, you have your hand raised as well. We'll go to Alex and hopefully there'll be some time at the end, Warren, to hear from you as well. Alex?
Thanks. Can you hear me okay, Laurel?
Yes.
Yeah, I'm on the legislative committee for Mid-Valley Healthcare Advocates, and we had a subcommittee that looked at this, spent about a year looking at this a couple of years ago, and the figure we came up with was 16 billion. But I just wanted to emphasize, we looked at all the revenue sources, and I wanted to say flat out, one of the things we decided was the sales tax is a non-starter. Oregonians don't want a sales tax, and you might reduce your projection from 6 to 3% or whatever, but it's still going to be a sales tax. As to, and Les commented, he'd like to see more of an income tax. Well, we came up with a couple of plans, and we came up with a document designing a funding system to support universal health care. We made that available to members of the task force, so you should have it somewhere. But we had a couple of plans that used both an income tax and payroll tax. They're slightly different. One used a straight income tax, one used a surtax. And one of our payroll taxes was a split 50-50, and one was just on employers. But the important thing I want to stress to the tag here is that we had no problems coming up with this and satisfying the requirements. Again, this was 2 years ago with $16 billion. But I want to especially stress, and I'm glad Warren's on the call because I want to make this short and defer to him if he wants to chime in. But he commissioned a poll by the Elway Institute and asked people, were they willing to pay double or more income tax in order to not have to pay premiums, deductibles, copays, and all the other out-of-pocket expenses? And the majority of Oregonians supported that, even among the business community. And it was and it did not fall along partisan lines at all. So there is support for paying both income tax, a higher income tax, even doubling the income tax, as well as the payroll tax in order to provide funding, the proper funding sources. And I will say again, a sales tax, again, we looked at how to implement this quick, using existing structure without creating new structures, which a sales tax would do. We have payroll taxes already. We have income taxes already. It's been much less of a lift. So anyway, that's what I wanted to get across to the committee, and now I'll defer to Warren.
I think if folks have a couple more minutes, we can hang back so Warren can chime in.
Okay, thank you. I just wanted to add a couple of things quickly. I think going back to the purpose of what we're trying to do here with universal care is we're trying to save a certain amount of money so that they can cover everybody and use part of the savings to cover everybody and part of the savings to save everybody some money. That can be done basically with almost no income transfers at all. And yet almost everything that I've heard today is, if we look at Sam's number of $20 billion, there's about $22 billion that's currently being spent. We don't really necessarily have to reinvent that with a new tax. I mean, if everybody just paid 95% of what they're paying now. And so I think there is an advantage of looking at the transfers rather than trying to design a new tax. What we've done today here is to take a minimum of 10 billion, a maximum of 15 to 18 billion that's currently being spent, and to throw that away and start over. So I think there is an important thing that the money is already being spent. More care needs to be looking at where it's coming from and to not throw that away. Thank you for the ability to comment.
You're on mute, Chuck.
Alex, could you resend our staff or one of us the copy of that so we can share it, that report, the Mid-Valley report?
Sure, be happy to.
Great.
Send that to Laurel, or who's that go to?
Yeah, that'd be good. And then she can get it to all of us. Yeah.
And incidentally, there's an interactive tax calculator in there that Warren did, which is even more fleshed out than the, I mean, Laurel.
We're aware of it. We're aware of it.
Thanks.
So we skipped over whether we should have any questions for Glendora's committee, Citizen Advisory Group, Consumer Advisory Group. Do people have any questions on that, or should we think of something that they'd like to ask?
Are there any folks who are small business owners on the CIC? Because I thought I heard someone bring up before, like that might be something to bring to the.
Yeah, we have an optometrist who currently is a small business owner. We have an individual who owned a bike shop for a couple decades and struggled with health insurance aspects. We have a member who is a former minister of in rural Oregon, and recall she reported that, help me, Glenn, I may get this wrong, that like only that a third of congregations don't provide health insurance to their ministers. It's either a third or a half, but a striking number of religious communities can't afford health insurance. So yep, we have some small business owners. And by the way, I can send around to the committee how the members responded to the previous questions. I took notes and can just kind of summarize, no, not summarize, repeat their comments.
That'd be great.
Send that around.
That'd be great.
Also, you can access them directly on the website, Oregon.gov, CAC.
And then it's tape recorded, of course.
So we might want to change our tag name to it's complicated, but so thank you, everybody. I thought it was a good meeting. Hope everybody else did too.
Thanks, everyone.
Bye.
Everyone.
Hi, guys.
Bye-bye.